It's been said that property has made more millionaires than any other investment, and today I'm going to show you exactly how to buy a home without a deposit. If you find value in this video, remember to hit that subscribe button. Recently, I met a couple looking to buy their first home. Harper and Madison were after a no deposit home loan. In our meeting, one of the first things I asked was, have you ever heard of a guarantor home loan? Looking confused, I continued. It's a loan that allows you to buy without a deposit and is done through the use of equity. Let's say your parents own a home. The difference between the value of their home and loan is known as equity. Harper said,
"Oh, that's right. I've heard of it. It's the same reason you pay mortgage insurance."
"That's right," I said. "Providing you don't borrow more than 80%, mortgage insurance isn't applicable. And a guarantor home loan is quite similar. Providing your parents have enough equity to support their loan plus 20% of the property that you're looking to buy, then you might be eligible." This time, Madison spoke up and asked,
"What's the catch? It sounds too good to be true."
I agreed. While you do own the debt lent against your parents' property, if you were to default, then they would become responsible for this portion. Madison spoke up again.
"We wouldn't want to do this to our parents. Are there any other options available? What about the home guarantee scheme? Would we be eligible for that?"
"That scheme," I said, "is very similar to a guarantor home loan, but you'd need a 5% deposit with the government guaranteeing the remaining 15% portion, allowing you to buy a home and avoid mortgage insurance. But I'm afraid as you're both New Zealand citizens, you wouldn't qualify as would need to be an Australian citizen." Harper went on to say,
"That's okay. My parents are actually thinking about relocating back home and would be looking to sell their property to us for a great price. Couldn't we borrow a little bit more if it's worth more?"
I said, "Yes, you could, providing the bank values your home higher than the price you purchased it for. We could lend to you 100% of the purchase price, providing your parents would write a letter saying that they gifted you this equity which was held in the property." Harper interrupted.
"What do you mean?"
I went on. "Well, say your home is worth 100,000 more than what you bought it for. All the bank would want is a letter from your parents saying that this portion is gifted to you." Harper and Madison would go on to buy their first home with no deposit down through the use of gifted equity. This is just one of many examples in how you can buy your home without a deposit needed. Today, I'm going to show you 11 proven ways you can buy a home without a deposit. If you want to learn how to buy a home without a deposit, then this video is for you. Gifted funds or equity. The first way to buy a home without a deposit is through the use of gifted funds or equity. Receiving funds is where the money is given to you either from friends or family, and banks will want to know that the money is gifted, meaning that it's not a loan and that the gift giver is receiving no interest in the property. That is to say, ownership. In order for these funds to be considered a part of your deposit, the bank would want a letter signed from the gift giver, and here is an example of the wording that would need to be included. "I acknowledge and pledge that this gift is 100% non-refundable, that the funds are gifted for the purchase of a house in which I don't have any financial benefit or interest in. I will not be residing or living in the home." Now, before you think this option is out of the question for you, keep in mind 2/3 of parents in Australia help their children buy a home, and on average, they contribute $70,000 in gifted monies. This means that if mum and dad were a bank, they'd be considered the 9th largest in Australia. The next option is gifted equity, and as we saw in Harper and Madison's story, we know that if you buy a property for less than what it's worth, that you're able to borrow 100% of the purchase price. It only works if you're buying through a non-arm's length transaction. That's to say, without the intervention of a real estate agent. Ordinarily, you'd only be able to lend based on the lower of either the bank's valuation or the purchase price. The only exception to this is off-the-plan properties, and it's something we'll actually delve into later in this video, so stick around. Guarantor home loans. This is the most recommended way to buy a home without a deposit, and it allows you to borrow up to 105% of the value of the home, with the additional 5% going towards costs such as stamp duty. Ordinarily, 80% of the loan will be secured against the purchased property, with the remaining 25% going towards the guarantor's home. Now, the borrower will make repayments to both the facilities, with the guarantor only coming into play should the borrower default. This means that the guarantor's liability is limited to the portion they guaranteed, and in this case, it's the 25% portion, which would be the responsibility of the guarantor should the borrower be unable to make their commitments. Guarantors should always seek both financial and legal advice before agreeing to anything, and as a borrower, there are many benefits of a guarantor home loan, such as waived mortgage insurance, the ability to buy without a deposit, and receiving a much higher discount compared to someone borrowing with a minimal deposit. Now, guarantors are able to be removed and is typically done once the property you've bought is able to take over the full debt based on an 80% loan to value ratio. As a rule of thumb, it generally takes between 3 to 7 years to remove a guarantor and is highly dependent on the property cycle you're in and how quickly you're paying off the debt. Medical professionals. If you're a medical professional, then you might be able to borrow up to 100% of the home you're looking to buy. This is highly specialized lending and it works with the loan being split into two. The first loan on offer would be a normal home loan and can be paid off over a 30-year period. This would be the first portion and it would make up 90% of the loan. The remaining 10% would be offered on a term facility and generally is paid off within a 5 to 10 year period depending on the bank's assessment. Not all lenders offer this type of facility. Depending on your profession, this option may not be available to you. First home guarantee. Think of this as a guarantor home loan, but instead of it being a family member, it's the government. For this scheme, you'll need a 5% deposit down, with the remaining 15% being guaranteed by the government, allowing you to purchase your first home without the need of mortgage insurance. To be eligible, you have to be an Australian citizen. Individuals can't earn more than $125,000 per annum, and couples no more than $200,000. This is based on your most recent year's Australian Tax Office Notice of Assessment. The property you're buying must be intended to be used for owner-occupied purposes, and you will need to be a first home buyer. This scheme will help you save big on mortgage insurance and will also potentially increase the discount you receive, as would be considered an 80% LVR rather than 95%, although it's worth noting that all banks won't look at it this way. The last thing to keep in mind that there is a limit on how much you can spend on a home, and here's a state-by-state price cap guide. Buying off the plan. When you buy off the plan, you're buying a property which hasn't been built yet. This means you'll agree to a price upfront, then once the property is built, you'll pay for it. In early 2020, James bought a block of land for $525,000 off the plan. It took almost 2.5 years for it to be ready for settlement, and in June 2022, settlement was called. This was when James reached out to us asking for help with the finance process. One of the first things I did was arrange the valuation, which is typically one of the parts of the process that takes the most amount of time. 7 days later, we received the report and the land valuation came in at $900,000, almost double the price James had originally paid for it. Whilst not generally the case, in this instance, the bank allowed us to actually lend based on the valuation amount and not the purchase price. This was due to the amount of time that had lapsed between when he had entered into the contract and when the settlement date was called, meaning James was able to borrow 100% of the purchase price, buying without a needed deposit. Owner finance. This is where you're financed through the seller and not the bank. It's like the seller becomes a pseudo bank. Whilst you do technically own the property, the seller holds an interest on the title until it's paid off. Before you buy a property, you'll agree to terms with the seller such as the purchase price, the interest rate, the term, and your payments. Unlike applying with the bank, owner finance is a private agreement between two parties, and it means that lending criteria doesn't apply and won't need to be considered. So long as you both agree to the terms, then you're good as gold. Rent to buy allows you to move into a home with a 2.5% deposit. You essentially buy now and pay later based on your pre-agreed purchase price. During the period, a portion of your rental cost goes towards your future deposit. When you do eventually buy the home, you'll do it through the increased equity and the deposit you've saved over this period. Without going into too much detail, rent to buy is one I would personally avoid. If you delve into the details, you'll see that it's really designed to make money from people who aren't financially literate and is no different to any other rent to buy schemes. So best to avoid. Partner with someone. Another way to buy a home without a deposit is to partner with someone. I see it all the time where people have a great deposit but don't have the borrowing power to support. Partnering with someone will help with this. So in this case, where one person has saved up a deposit but has little borrowing capacity, by joining forces, you'll be able to purchase a home. It's a great way to enter into the property market, and it's a win-win situation, stacking grants. When the Home Builder Grant was first around, I had customers who were buying homes with no deposit, as they were using both the $25,000 home building grant in conjunction with the $15,000 first home buyers grant, meaning they were receiving $40,000 in government grants which they used towards their deposit. Depending on which grants are available, it might mean that you're able to take advantage of this strategy. Because this is always changing, it's worth looking into what's available in your state at this time. To have your entire deposit come from government grants, bank will want to see 12 months of clean rental history and will want to see no missed repayments on your credit file. Here are a few grants which are available right now. In Queensland, if you're buying or building a brand new home valued up to $750,000, then you might be eligible for $15,000 in government grants. This is the same in Victoria, but it's only $10,000. In New South Wales, it's $10,000 for both homes valued up to $600,000 and new homes valued up to $750,000. And in Western Australia, it's $10,000. In South Australia, it's up to $15,000. In Tasmania, $30,000. And in Northern Territory, it's $10,000. Advantageous purchase. This strategy is so rare that I've only seen this once in the past decade. An advantageous purchase is where you buy a home for significantly less than its market value. It typically occurs when a property is sold due to a dispute, a divorce, a deceased estate, bank repossession, practically any reason that a home is sold fast without the necessary due diligence. And as I've already explained, the banks will ordinarily lend based on the lower of either the purchase price or valuation. But with an advantageous purchase, because the gap between the valuation and purchase price is so large, banks will use the valuation to lend against accordingly. This means that you'll be able to borrow at 100% of the purchase price. Equity. This one is no good if you're a first home buyer, but essentially, if you own a property, it allows you to leverage equity that's available to purchase the next without a deposit. The first step is to find out how much money you'll need to contribute to purchase a property based on an 80% loan to value ratio. Include both the deposit needed and the associated costs. As you can see, if you're buying an investment property in Brisbane for $500,000, then you'll need about $120,000. Now we know how much we need, let's take a look at your home. And we can see you have heaps of equity available, currently with a loan to value ratio of 50%. As previously mentioned, you're looking to buy an investment property. We already know that you'll need about $120,000 to cover the associated cost plus the 20% deposit. This is the amount you'll need to secure against your home. Because of your equity position, once you've funded the money needed, your loan to value ratio will be 62%, and it allows for both your purchase property and your existing property to be under an 80% loan to value ratio, meaning that you wouldn't have to pay mortgage insurance on either property. And in summary, due to the equity position in your current home, you were able to fund 100% of the purchase price plus the associated costs, allowing you to ultimately buy a home with no deposit needed, waive lenders' mortgage insurance. If you have a deposit saved, you might be surprised that some lenders will in actual fact allow you to waive their mortgage insurance. Providing you have a 10% deposit, it's dictated by your profession. At the moment, some job titles include pharmacist, nurse, accountant, legal practitioner, physio, dentist, veterinarian, and the key industries which the banks look at include the finance, legal, and medical profession. Things to keep in mind. No deposit home loans doesn't mean no upfront costs. Depending on your unique situation, you might still need to come up with upfront costs such as stamp duty, conveyancing, building, and pest. You may also find that interest rates offered for no deposit home loans are considerably higher. Banks will also increase their scrutiny when assessing your application. It means that if you're looking to go down this path, it's best to prepare before applying. Here are 3 things you can do right now to prepare. 1. Go through your bank statements and cancel any unnecessary subscriptions. 2. Get a copy of your credit file and make sure that your credit score is over 650 with no missed repayment history. Close off all your credit cards and your buy now, pay later accounts that you don't use. Finally, you want to make sure that you have the ability to meet the repayments to your new mortgage. The best way to do this is to include a buffer on the interest rate you'll receive from the bank. As an example, if you've been quoted a 5% interest rate, calculate your payments based on an 8% instead. The additional 3% buffer will ensure you're prepared should rates increase. Ultimately, you're entering into a big financial commitment, so you really just want to be comfortable and prepared for what you're getting yourself into. Here at Hunter Galloway, we're mortgage brokers who get home loans approved. We help Australia-wide and don't charge a fee for our service. So reach out and contact us online at huntergalloway.com.au or call us on 1300 088 065. Thanks for watching, and until next time, I'll catch you then.